Hello, everyone, and welcome back to today's daily analysis. Today is the 15th April 2024. The US dollar has shown significant strength since the middle of last week, breaking through the old resistance levels and achieving its highest point of the year at 106.10. The rise has been fueled by multiple factors, including the rising US Treasury yields, a favorable inflation environment, and a hawkish expectations regarding potential future rate hikes by the Fed. Global uncertainties, such as concerns over the Iran's threat to Israel and the European Central Bank shifts towards an interest rate cut, further bolstered the dollar's status as a safe haven currency. From the technical analysis perspective, the US dollar index recorded its largest weekly increase since September 2022 and its highest level since November of last year, suggesting continued bullish momentum. The indicators suggest at the 14-week RSI and MACD support this trend, highlighting the strong buying activity. The potential upside targets include 106.51 and 107, while the downside focus is on 105.38, 105, and 104.85. For today, there's a recommendation to consider going short the index near 106.2, stop loss at 106.4, and target levels at 105.8 and 105.7. Next, for the spot crude oil. Last week, the WTI crude oil rose by about 1.66% amid geopolitical tensions in the Middle East and concerns about the potential supply disruptions, particularly due to Iran's potential actions against Israel. However, this week the trend turned downward due to the International Energy Agency's pessimistic forecast of the world oil demand growth and the concerns about potential US interest rate cuts. The supply chain issues remain a risk, with Iran's threat to close the canal contributing to a rise in commodities even as the US dollar advanced. From a technical perspective, the daily chart shows that the WTI crude oil reached a high of $87 last week before retreating below $84. If the crude oil prices can reclaim the 87 level this week, they could advance further towards 88.37 and the $90 mark. The further escalation in the Middle East may even drive prices to $94, potentially setting a new 18-month high. On the downside, support is at $84 and $83.97, and a failure to hold these levels could lead to further decline at 81.6. Today, there's a recommendation to consider going long on crude oil near 84.6, stop loss at 84.4, and targets at 86 and 86.3. Next, the gold prices have experienced a strong bullish run over the past few weeks, reaching an all-new high of $2,431.50 early Friday amid the heightened geopolitical tensions in the Middle East. This upward momentum has been fueled by concerns over the conflict in the region, which has driven investors to seek safe haven assets such as gold. Additionally, expectations of the interest rate cuts by major central banks have provided further support for the non-yielding metal. Despite hitting this new high, the gold prices fell back to 2,333.8 due to a strengthening US dollar. In terms of technical analysis, it indicates that gold's near-term demand remains strong, with all short and long-term exponential moving averages trending higher. The 14-day RSI stands at 83, reflecting ongoing bullish momentum, but also suggesting overbought conditions. The short-term targets include testing 2,377 and 2,340.9 levels, with the next target at 2,388.3. The downside support is at the psychological level of 2,300, which, if breached, could lead to further declines to 2,267.8 and $2,263.8. Today, there is recommendation to go long on gold before 2,340, stop loss at 2,335, and targets at 2,365 and 2,370. The AUD USD currency pair continued to face selling pressure on Friday and reached a near 2-month low at 0.6456 following weak Chinese trade data. The pair failed to hold the psychological 0.65 mark and closed near the weekly low of 0.6459. This ongoing downward trend is being driven by strong US dollar buying, underpinned by expectations that the Federal Reserve will maintain higher interest rates for longer amid persistent US inflation and geopolitical tensions in the Middle East, favoring the safe haven US dollar. From a technical perspective, the AUD-USD pair fall below the 0.65 mark suggests a bearish outlook and may set the stage for further losses. Continued selling below the 0.648 area may lead to the pair to retest the year-to-date lows around 0.6442. Further declines may extend towards the 0.64 mark and possibly reach the 0.635 area. On the upside, any recovery attempts may face strong resistance near the 0.6545, 0.6555 area, which aligns with the 200-day simple moving average. Targets around the 0.664 to 0.6645 area could be reached if the pair surpasses the 100-day moving average at 0.6598. Today, a long position may be considered if the pair reaches 0.6448, stop loss at 0.6430, and target sets at 0.65 and 0.652. The GBP USD currency pair fell below the psychological support level of 1.25 last week, with the strengthening US dollar weighing heavily on the British pound. The US dollar strength was driven by rising US inflation data, which shifted market expectations away from interest rate cuts by the Federal Reserve. In the UK, despite positive factory data and an expected increase in the monthly GDP, the pound struggled to find buyers. Looking ahead, with the UK inflation data expected this week, any deviation from the market forecast could add further volatility to the GBP USD. And from the technical standpoint, the GBP USD experienced heavy selling pressure after the release of the US CPI data last week, easily falling below all three key moving averages. If the pair attempts to move higher, the 55-day, 100-day, and 200-day moving averages will act as resistance levels. Conversely, if the current decline continues, the next support levels are at 1.239 and 1.2364, with the potential to reach the psychological barrier at 1.23. Today, a long position is recommended before 1.242, stop loss at 1.2405, and targets at 1.25 and 1.2505. And then for the USD Japan Yen pair, experienced a significant rise last week, reaching a high of 153.38, its highest level since the 1990s, supported by the strong US inflation data. The increase in the Consumer Price Index (CPI) to 3.5% year-over-year in March, along with the stable core CPI, fueled the hawkish expectations for the Federal Reserve and the Treasury yields, pushing the pair to hit a new 34-year high. Despite the signs of weakening US consumer confidence, the continued strength of the dollar, paired with further potential gains as per expectations, have created a bullish outlook for USD Japan Yen. USD Japan Yen remains comfortably above the previous intervention level of 152, with Finance Minister Suzuki expressing concerns about the negative volatility caused by the yen's recent decline. From a technical standpoint, the weekly chart shows a continued positive trend for USD Japan Yen, with a 14-week RSI indicating bullish momentum. The MACD histogram also supported the buying momentum theory, with the currency pair rising above 151.9 of the ascending triangle resistance line last week. The US dollar may test higher levels of 154.66 and 156.36 yen in the future. On the downside, focus is on the 151.9 and 151.35 as potential support levels. Today, there is a recommendation to short the US dollar before 153.6 and stop loss at 153.9 and targets at 152.5 and 152.3. And lastly, we have the Euro USD pair, which extended its losses to near 5-month lows, near 1.062 heading into the weekend, amid strong speculation that the European Central Bank (ECB) will cut interest rates starting in June. The ECB held its main borrowing rate steady at 4.5% to maintain downwards pressure on inflation and did not commit to any specific interest rate path. The central bank monetary policy statement indicated that restrictive financial conditions and pending measures to raise interest rates are weighing on overall demand and driving downward pressure on inflation. The speculation that the ECB will shift to rate cuts intensified after ECB President Christine Lagarde said that the rate cut would be appropriate if the new assessment increased policymakers' confidence in inflation returning to the target. As you can see here on the daily chart, the pair is falling sharply in the middle of last week, when the US Consumer Price Index data confirmed stronger inflationary pressures, and the pair continued to plummet, accelerating its decline towards the end of last week, easily breaking through the key levels to reach a low of 1.0622, the lowest in nearly 5 months. Currently, the Euro USD is testing at 1.0596, with the next level looking at 1.0516, while the 1.07 to 1.0712 is the first resistance level for Euro USD. If the pair stabilizes above this level, it could encounter obstacles around 1.0765 and 1.077. Today, it is recommended to go long the euro before 1.062, stop loss at 1.0605, and targets at 1.068 and 1.0695. And that is all for today's daily analysis. Thank you for watching and have a nice day.